What an insane close on Friday, with the month-end rebalancing really showing us where money managers are overweight and underweight. NVIDIA and Intel got sold aggressively, whereas Micron and SanDisk got bought aggressively. Microsoft, the cybersecurity names, and ServiceNow held bids into the close as well. So is the trade here to sell select hardware, stay involved in memory though, and then flip to rotate back into software? We'll see, but it looks really good for now. The other big cliffhanger is the IREN deal that was supposed to be reached this weekend. As of Saturday morning, there's not much to update, but it would just be oh so classic to have the market top once the deal is done. Remember, markets tend to bottom on the worst news, and then they tend to top on the best news. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame, talking about candle structure and location now that the monthly bars for May have officially closed out. What do we see here? Solid green bodied bar, very strong close at the highs of the monthly range. Pretty self-explanatory unless you've been living under a rock. We've got ourselves a severe month-to-month higher low as well as a higher high, and a candle close in blue sky territories. Now, of course, in the dominant trend count, this just means that we have a higher high in the trend count. And although there is no indication of a pullback looking imminent, if something were to take place and we were to pull back and support over previous areas of resistance, which could now act as potential support. The number there is the 700 round figure. If we use previous highs for a new higher low, the monthly trend will just remain in the upward direction. So that looks great to me there. I will just point out that we've absolutely smashed the resistance trend line here. If you watched the April analysis of the monthly bar, I was sort of a proponent for saying, I don't think it's going to cause any concern. The main logic for that is if you just go back and study upper resistance trend lines on higher time frames, they don't do anything. So fine, great. We smashed through that in the upward direction. The trend remains in the upward direction. Really nothing to complain about here on the higher time frame. I would just go back and remind folks that if things are going to get really severe and nasty, if this is going to be a dot-com bubble bursting all over again, just remember that the monthly trend will flip to down. You will have an opportunity to get out of this. This is the dot-com bubble bursting, double top. There you are, lower high underneath the monthly 20 SMA. Leg number 1, they even gave you another lower high opportunity right here to get out of this thing for leg number 2, leg number 3. Right? So there's plenty of time to identify, or there should be plenty of time to identify based on historical precedents when the market is rolling over on a higher time frame. That's the dot-com bubble. If we just scroll over just a couple more years, you can see the great financial crisis does the same exact thing. There's your monthly double top. Here's your neckline. There's your lower high under the 20 SMA. We've broken the neckline, set the lower high. Oh my God, that's painful, right? That's where things get nasty. It's not like you just fall out of bed from the high and go straight to the downside. So if we just go back on over to where we are currently, we're just not even close to having that conversation. We're not even close to breaking down through the monthly 20 SMA. We just closed at the highest high. If we're going to do this at some point in the future, fine. We'll be able to identify it with plenty of time. Let's go ahead and talk about the low volume. I haven't seen anybody complain about it yet online, but I'm just waiting. Low volume, people tend to freak out and say, oh my God, the market's running on fumes. It doesn't matter. Look at this low volume bar over here. If I just hover my cursor, it's this bar right here. The market continued to grind in the upward direction for quite a while after that, many months, right? If we take out some measured moves in here, let's go ahead and take out a Fibonacci extension from the low up to the high, down to the low of the pullback. We're at the 61.8. I really don't put much emphasis on that. It's kind of like that resistance trend line we just looked at, but a mirrored move, a measured move of the bull flag should suggest something near about 850. Now, am I arguing for 850 in the coming weeks, months worth of trade? It doesn't have to get there in the blink of an eye, but that would just be a nice round figure with some symmetry behind it to potentially pay attention to. Again, not just automatically short the market, but pay attention to when and if we approach 850, right? So that's the monthly analysis here. Let's drop it on down to a weekly. Let's start to see what we've got from this perspective. As a matter of fact, before I forget, as we're thinking about expected moves and extensions to the top side, here's the monthly expected move for June. You can see the upper bound is actually confluence with the yearly upper bound of the expected move. It's right there around 784. Now, if you just look at what we've done over the last 2 months, here's April, smash the upper edge. Here's May, smash the upper edge. So would I be shocked if the market comes into this and backs off a little bit? I wouldn't. You're not going to sustain just complete blowouts of the expected move forever. Doesn't mean I'm just going to be short there at 784, but I'm just giving you an idea of what the market's pricing in terms of options and where that sort of measured forecast is. It is confluence with that upper 784 we've had a heck of a run. Are things going to slow down, sell in May and go away? A little bit quieter over the summer. Not sort of like, it's not my base case. I'm not just going to assume that's going to happen. But if we do back off from that or remain a little bit more contained this month, I would not necessarily be shocked. Anyways, let's go back on into a clean drawing set here. Let's take a look at our candle structure and location as we typically do. What do we see in terms of structure? Solid green bodied bar speaks for itself. A little bit of an upper wick, a little bit of a lower wick, not much. Strong close, buyers in control there. You could certainly see this as a bar to bar high or low, as well as a bar to bar high or high candle close completely outside of a 2-week balance range in here. So if this is a 2-week balance range break in the upward direction, we should technically double the range, right? And so if we just throw on a little Fibonacci extension, we're really talking about roughly 767.35. That would just be, again, not a number to just go out there and short as soon as we get there. But once we get there, a little bit of slowdown, a little bit of like, hey, let's pay attention a little bit more so to see if we go sideways. Does the market pull back just a little bit? Maybe we slow down the look for new money longs there. That's a range break as it relates to this as a little balance. If the market's going to fail, it's very obvious where that needs to step up. That's underneath roughly 748.50s. If we take out last week's low, I think you would just rotate to the bottom end of the balance range, which is just a look above and fail, right? If this is going to be a look above and fail, a lower high, and we'll see this on the daily with clarity in just a second, then fine, we target the bottom end of the range. That's where things get a little bit more hairy, right? If you start to suggest a weekly lower high, now you've got your sort of head and shoulders, if you will. Underneath this, yeah, I mean, you could easily start to see a deeper pullback. Maybe we get that monthly high or low. I'm not going to sit here and I don't want to drum up the bear argument until it's actually ready. So like, is this a back pocket situation? Sure. Is it the base case? Absolutely not. Let's go ahead and throw on a Fibonacci from the weekly perspective now that we've made a new high. Coming up here, you can see the Fib 38.2 continues to just drift away from the previous all-time high. The new number is roughly 709.25. I'm not going to get too hung up on that. There is a level in here closer to about 712.40s, which can act as a structural higher low as well. That may be the next spot to really pay attention to if we do end up seeing that look above and fail, right? And again, I don't want to be overly bearish. I just want to continue to preface this by saying, hey, the market's in total bull mode right now. We are getting a 2-week balance range breakout. Let's not get overly bearish. But if there is some kind of reversal, if we do see that head and shoulders, right, and then we're here, left head, right, great. If we do something that looks like this, a weekly higher low would technically keep us above the monthly line in the sand at 700, the previous all-time high retest. So just stacking a little bit more confluence around that particular level. Let's go ahead and clear that one up. Let's take a look at our weekly anchored VWAPs. As we know, this will take some time, this stack in here, but as we go forward, the next week's worth of trade, it wouldn't be unreasonable that this starts to get even closer to that 712.40, once again reinforcing that if there is that breakdown, we at least know the level that we should be paying attention to. I'll say it one more time just so everybody can write it down. It's 712.40. We'll see it on the daily chart in just a second as well. Not much to write home about if I grab the volume profile on the weekly. As you can see here, you do have this high volume node acting as the lows of the 2-week balance range. We talked about it last week. I don't think it's much of a threat, at least early on this upcoming week, unless there's a massive failed breakout, which for now doesn't really seem to be the case. Let's drop this thing down to a daily timescale. We know that we're bullish across the board, across the timeframes here. On the daily timescale, we will start by evaluating this week's expected move, which is this gray shaded area right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. That will also help you set those monthly expected moves that I just showed you as well a moment ago. Let's go ahead and take a look at the upper bound. It's going to be at 766.61. That, of course, implies a brand new all-time high, highest high in the trend count, bullish there. If we're contained by the lower bound, it's 746.35. I don't love that because it would start to suggest that failed breakout of the 2-week balance range, right? But in general, is that still a daily high or low? Absolutely, right? Daily high or low would persist if we're over that 746.35. You could see from here to here, no doubt about it, we have not achieved an hourly downtrend. And therefore, I'm still bullish on the daily timescale. Even the expected move here suggests that the uptrend will remain intact. So I think very straightforward. Any consolidation over the 2-day balance range highs from Tuesday and Wednesday of last week, 751.75, looks good for just stacking hourly higher lows. And then we look for a Brigade bolt out to blue sky territories. Again, upper bound of that extension from the 2-week balance range. I could just show it to you here. If we just grab the low to the high and stack the measured move, it's right there, right? So not much of a shocker that you may see a little bit of slowdown, a little bit of timidness from the market if we approach that 760, let's just call it 767 as the round figure, all right? So that's your top side. Once again, consolidation here, Brigade bolts out to the highs. If you do pull back a little bit more deeply, I think we shouldn't be overly concerned as long as we're holding 748.75, lower bound of the weekly expected move. That would be the pathing that I would try to follow going forward. Base case would be looking for continuation in the upward direction. A threat to the base case would be if we come back down, suddenly we start suggesting One. Two, everybody starts screaming about double top. Remember, it's not a double top until it is. You actually have to crack the neckline, but this would start to indicate that failed breakout situation we just talked about on the weekly. Again, not a base case. It's a back pocket situation that we could at least identify if it starts to shape up. But right now, the market is certainly bullish enough where the base case should be seeking continuation of the daily trend until, what do we say? I think, we'll claim this one as our own. Some guy, Isaac Newton, might have had a spin-off, but a trend will remain intact unless acted upon by an outside force. Right now, the trend is up with momentum, so we want to go with that trend until something acts on it from an outside perspective. So that's it on the daily time scale here. If we drop it down to the hourly chart, what do we see as we get more granular, start to build a little bit more of a path and game plan? Really on Friday, market didn't do a whole lot of anything other than except above Thursday's range. Like as much as it was a nothing burger on Friday, just going sideways back and forth in barcoding, you have to remember where that shaped up. That was over the highs of Thursday's session. Remember, on Thursday, we opened in the midpoint of this range after what I would say was a little bit of a volatile overnight session. I think I could just quickly throw on here the extended hours and zoom in a bit. Let me just do this really quickly, right? We had a little bit of volatility headed into that Thursday session. Thursday morning, we get those big data points, right? It was the PCE, GDP, jobless claims, durable goods. We end up opening inside the range here, and then we break out. So my main illustration, what I'm trying to suggest here is that if we had stronger sellers, they should have capitalized on this movement here, or even an open in range to break underneath the Tuesday, Wednesday lows, reverse the hourly trend, and accomplish the pullback here that we were talking about in the Wednesday midweek market update video. That was at 743.50, and it just didn't happen. So as we consider the types of participants that are getting involved in this market, I continue to go back to the question, do we have new money sellers entering the market? And I continue to answer that question by saying no, absolutely not. There's no hourly trend reversal. There was an opportunity here on Thursday. Sellers failed. And Friday, consolidation, aka acceptance of the auction, was higher. It was over Thursday's range. So bullish across the board there. The Fibonacci's will no longer offer beautiful confluence for the daily. Oh, I should bite my tongue. I guess when I was looking on Wednesday, the 38.2 was in here, but we've made a high enough high. I guess I should have done my homework as well, but hey, we're doing it real time. 38.2 is now the lows of the previous left side peak and the balance from the 2 days of Tuesday, Wednesday. So that's actually great around that 748.75. As long as pullbacks, sustain above that, we're looking pretty darn good here. Let's clear that one off and let's take a look through the intraday anchored VWAPs. Where is it? Here it is. Really no need to anchor something until we actually pull back for a couple of days. Then we'll have a high that's set. But for now, all of these are just below us. So the entire stack underneath means that buyers are in control. Even anybody who chased it at this very tippity top, the average buyer from there obviously is feeling just fine. So could you anchor one in here? Sure. We're probably above that, looking something like this. I think there's just plenty of reason to be bullish as long as we're over the previous left side peak, 748.75. Once again, our simplified pathing likely looks something along these lines where, we're basically going to look for consolidation and continuation on the hourly. That's great. We could look for a break of Friday's low, pulls back to the 2-day balance range high, Tuesday, Wednesday. You do this, reclaim the Thursday consolidation lows, and then you're probably back off to the races here. Bull flag, Brigade bolt up and out. If we do pull back a little bit more deeply than that, right, this is still first thought bullish. If you start rejecting in here, right, this gets a little bit hairy. I'd say, okay, a little bit hairy there. You break down underneath. You have that failed breakout look from the daily perspective. That's not a base case. There's lower odds of this, I would say, as of right now. I instead would be thinking, okay, maybe this double bottoms 1 and 2. Then you're back here seeking continuation over time. That's great. What else can we say? There is the opportunity to short a failure pattern into highs. So if you want to take a quick snap of the basic pathing here, these are base cases with this being lower odds. And then I would also say if the market tries to break out, fails back below, that's fine. You just set a brand new highest high in the trend count. You could pull back and you could still achieve higher lows here and seek continuation, right? So the only difference in this particular path is that you do actually have a shortable failure pattern from point A to point B, in which case in here, I would reevaluate and start looking for daily higher lows. Right? That is the name of the game here on the hourly chart. I think fairly straightforward, and it's been that way for a little while now. Here's the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see as it relates to the net impact on the week? Breadth expansion on Tuesday, Wednesday looks fine. Thursday, breadth expansion. Friday, a little bit wishy-washy there to end out the month, but nothing that's overly negative. That's the key point. Nothing overly negative in terms of volume net outflows from the market. If you look at the AD line, most of the week spent over the zero mark, just a little bit of a struggle there on that Friday session. I don't really even think that's the end of the world, right? In my view, this is like not an overly aggressive trend lower zone. We're not even close to negative 1500. It's like, hey, we're kind of balanced and sideways. And lo and behold, what was Friday's session like? Balanced and sideways, right? If you take a look at the cumulative builds across the tick, maybe a little bit of a slowdown there at the exchange level, just meaning that the momentum wasn't actually sustained intraday. And I think that's a fair point to make as well. I mean, outside of Thursday, which was one of the only more bullish builds on the cumulative, you didn't really have a very interesting intraday action, right? It was like, okay, a little higher, a little lower, sideways, ramp it to the close, sideways all day on Tuesday. Thursday caught that bid. Great. We do have the cumulative build up. And then on Friday, once again, just completely neutral, not really doing anything, but location wise, bullish over the previous day's range. So I don't think there's any underlying divergence here at the internals level that makes me think, oh my goodness, duck and cover. It's going to get nasty. Here is the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right hand corner. I would just say a couple of things. Look at value. As value built out on the week. Here's Tuesday, here's Wednesday, point of control slightly higher. Here's the Thursday session. And once again, this is where the bears had an opportunity after this overnight session volatility to keep value overlapping to down. And it just didn't happen. Value is completely clean to the upside on Thursday. Point of control is higher. We even left behind some single prints in B period. As we look at the Friday session, I mean, it speaks for itself. A very balanced session. Perfect normal distribution, point of control literally at half back here in the middle. I don't think there's really much to interpret from that point of view. So a normal market, a healthy market, a market that's just chugging along in the upward direction with no real concerns out there. Let's go back on over to the platform. Let's take a look through the Qs and the NASDAQ 100. Let's bump this thing up to a higher time frame monthly. We'll just try to get, I don't think we'll be able to, yeah, okay, there we go. We'll get that, and then we'll go ahead and throw on the clean drawing set. We'll start with the more recent stuff, of course, then we'll go look at the .com era. Let me just throw on those moving averages. There we go. So it speaks for itself. I won't waste your time. Solid green-bodied bar, higher high, the whole 9 yards. Pull back over the previous all-time high. That level is closer to that 642. As long as we get a monthly high or low above that, trend remains in the upward direction. Once again, the number is 642. Resistance trend lines, they're not worth paying attention to. Just like you snapped it in here, you of course can strike the same one and say, oh, look at that. No need to be bearish in the end of April, early May, because they just don't matter, right? So that is that perspective. We'll take a look at measured moves in just a second. We'll go back to the .com era, if you will, first. Am I missing something here? Why is that? Oh, it's because we're on the clean drawing set. If I throw on the default drawing set, what I'm trying to illustrate here is that as the market went sideways after the .com peak, right? You could look at the NDX if you want a little bit more price history off to the left. But at the .com peak, you had 161 days of sideways action where you could be considering, okay, is this a bull flag? Is it not a bull flag? And then that's going to be, right before, as you're breaking the lows of that bull flag. If you wanted to just simply avoid an additional 72% drawdown in the NASDAQ as the .com bubble was quote unquote bursting, I mean, there's no reason as a trend follower to be involved in a monthly downtrend. It just doesn't make sense. And we haven't had a monthly downtrend in ages at this point, right? I mean, the sickness flash crash was so fast that unless you were out that day, you may as well have just held it through the bottom and then it recovered very rapidly. So the illustration, once again, is that higher time frame monthly trend reversal will happen before really bad things happen in the market. And, you're subject to losing 50%, 70% of your account value. I mean, there's going to be signs as it starts to top. And we could even take a look here. Maybe before we go to the weekly, I'll just go back over to here. Let's throw that clean drawing set on. I just want to cover the measured moves before I show you that one more time on the weekly, because it looks like it happens quickly on the monthly, but it happens quite slowly on the weekly. So our measured move here from this bull flag perspective right there on the monthly Qs is up here at about 788. Again, actually, this is within spitting distance for the month of June. We'll see if we can get there. Another reason to just not focus on Fibonacci extension midpoints is look at us just blow right through the Fib 61.8. Not really a big deal, right? So that is what we've got on the extension. Let's go down to a weekly chart. I want to start as we're thinking about expected moves, talking about the expected move here on the top side, 777.27 for the month of June in terms of the options market pricing. And notice that we are through the upper bound of the yearly expected move. Doesn't mean that it has to crash and burn and, oh my God, it's got to come back in here and it's got to stay in the midpoint. That's not how these things work at all. It's a suggestion that was priced in back in January. Right, so we could exceed this by any amount, and that's fine, right? Options markets are dynamic. It's just what the market was pricing in at the beginning of the year. So that's the measured move set, but I do want to go back on over. If we throw on the default set and go just way out on a weekly chart, I want to go back over here to help illustrate once again that you had plenty of time. This is literally from, what is this? March of 2000 to September of 2000 as the market was going sideways and consistently yielding weekly lower highs off of the peak. You know, if you just took this as a decent indication and said, okay, we're underneath the weekly 20 SMA, we don't really have a weekly trend, we're breaking to a new lower low in here. If you got out there, fine, you avoided more than a 72.5% correction on your money, right? Even if you waited for the breakdown through the equal low. So you got a number of things happening at this point. Again, the illustration is to say, if you're scared of this market, if you're like petrified that, oh my God, I can't possibly be involved in the market because it's going to crash and burn, it's going to go to zero. If you're trading short dated options and you're just like full portfolio short dated options, yeah, you run the risk of getting seriously hurt. But long-term money in the market, again, trendline break under the 50 SMA on the weekly, the 20 SMA on the weekly, break the neckline, and then you could still dodge a 72.5% correction in the NASDAQ, right? So there are ways to see, that the trend is changing on the very high time frames. You'll also see it in the leaders. Like leadership in the market will just go to crap. Pardon my French, we typically don't tend to use words like that around here, but your leaders will stop leading. ARM is not going to be up the way it's up. NVIDIA will not be up the way it's up. The semiconductors are going to get hit, right? Software is going to be like, okay, we had a nice dead cat bounce in the higher time frames, but that's it. We're making new lows in software already. Consumer staples, oh, they're defensive, they're rallying. That's like here, right? Consumer staples, defensives rallying, that's here. When those things start to roll over alongside tech rolling over, that's this. So there will be signs if the bubble is going to pop, and it's always a great reminder whenever we have monthly closes to go take a look at this stuff. Jumping back down to the clean drawing set on the weekly time scale, I think this speaks for itself. Rinse and repeat of the same conversation we just had on the S&P 500. 2-week balance range breakout, strong green bodied bar, very little wicks on either side. Clean higher low, clean higher high. It's a breakout, right? If you want to take a range double, I believe we're pretty close at the 61.8. So 750, the round figure, would be your weekly doubling of the balance range. If this is like, hard to say that it's 2 weeks tight, high tight flag breakout here, but 750, right? We'll at least look for that. I would really hesitate to throw a fib on in this perspective. That's going to get us where? Closer to that 681. Yeah, I don't know about that, but a doubling of the range for this week, 750, certainly within striking distance. No real need to talk about downside references. We know what they are. We know where they come into play. Why is this giving me a funky zoom? Let's try that again. Let's come in from the lows to the highs, 38.2 in here at 670, away from the previous high set at this point. Before we know it, the 20 SMA and the fib 61.8 will be at that level. Never mind the fib 38.2. We'll throw on the anchored view apps just to be congruent on the higher time frame structure. Here we go. And what do we see from this perspective? A rinse and repeat of the same conversation. The reference points here will slowly play catch up over the next handful of weeks. This one will be closer to about 664, which is a stronger reference we'll see on the daily time scale in just a moment. That's all set. Nothing really to glean from the volume profile, but for the sake of being congruent, we do not need maximum time frame. We could drop this thing down to a 3-year chart is fine. Your volume node is the same thing as the S&P bottom end of the 2-week balance range, roughly around 695. Okay, now that we've covered that, let's drop this thing down to a daily. So get a little bit more granular. We've sort of gotten the high time frame perspective out of our systems, which is just that, typically markets only go up. But for now, QQQ on the daily time scale looks great. If you look at our weekly expected move, upper bound is up here at 754.03, implying a brand new all-time high, highest high in the trend count, and the lower bound is close to about 723.59, and that is implying a gap close as well as a higher low in the trend count. So expected move here is bullish in my perspective. This here is a small inverted hammer. I would even just argue doji on the Friday close. Think about the location of this. From people who use previous day's close to measure to next day's close as the percent change of the market, I like to just look at the day's change. That way it's the actionable range for day trades. But anyways, this is still up 37 basis points on Friday for the NASDAQ. Even though the structure of the bar does not look all that compelling, you're still up 37 basis points. So people, more classic, mainstream media for finance is going to say, yeah, it was an up day on Friday, even though we were kind of flat there. So looks fine. Location is fine over Thursday's range. Break out of this balance. go. I mean, there's just really nothing to complain about. You could go look above and fail on the daily, close the gap, daily high or low here, lower bound of the weekly expected move. Really paying attention to 722. Looks awesome. Some sort of like consolidation and continuation would work. Problems emerge where? If this turns into a daily double top, fine, we'll talk about it. When and if this happens, great. We have the multi-week balance range failure. Same thing as the S&P 500. So your key levels here, key reference is really just on the daily chart, going to be the gap close at 722. If we're above that on the daily, I'm bullish here, looking for upside. If we just get tight consolidation, heck, even a higher low that's above this level in here, by the way, is at 731.15. If we just get something really gentle like this and hold that, that's still a daily higher low. Might not be up against that key reference point, but it still is a reference point, 731.15, shallow higher low, consolidation, continuation. The story just continues. Let's go on down to the hourly chart here. Let's get a little bit more granular. Same conversation as the S&P 500. Very boring Friday, but location-wise bullish over Thursday's high. You also had what I thought was pretty compelling. You had on Wednesday a gap up that failed. We talked about the exhaustion gap over in the semiconductors, and that was just met with a bid. Right? That was met with a bid as we came back into range. We just talked about on the S&P, the overnight session headed into Thursday. I mean, if this was going to be a failure pattern, that is where the bears should have shined. The fact that the sellers could not yield a lower high in the NASDAQ under 731.15, close the gap even. I mean, just the fact that this gap is unfilled tells you everything you need to know about the sellers. They're just not strong. They're not here. They're not getting the job done. So buyers, it's the way to be. And, we talked about this on Wednesday. I'll say it again here. It pays right now to be an optimist in this market, looking for continued upside, higher low, shallow pullbacks. You want to be buyers of those, not sellers at the depths of the pullback low. It does not make sense to be a short watch here. It makes more sense to always be, at least right now in this current market regime and environment, makes more sense at support, literally previous resistance, to be on the lookout for where's the buyable opportunity. That's just the way the market's been moving. Now, we got to keep an open mind to like a trend reversal at some point, but until that actually comes, let's stick with the status quo. I think we've really beaten that dead horse around here into a pulp. Let's go ahead and do this. Fibonacci 38.2 right around the gap close area. I like that. That's the top of the gap. Technically, I would still just give it the leeway into the gap close, lower bound of the weekly expected move. Let's clear that one up. Let's throw on our intraday anchored VWAPs. And as we could see here, slowly over time, these will provide confluence around this area, as will this one later on. And it's probably even worth just anchoring one here really quickly. Let's just take, what is this day? That's the 526 bar. I just want to see where this is. So 5, and then we'll come back over here and say 26, and we'll just see what that gives us in terms of an anchored VWAP. Yeah, I mean, just as of right now, slowly this week, it'll play, something like that. And that's just going to keep us over the top end of the 2-day balance range from Tuesday, Wednesday of last week. So I really don't see many bearish arguments here in the market. We know where the bearish argument steps up. We'll just come in here with the simplified pathing as we did for the S&P. Base case, consolidation, and go. If you break down, support here, reclaim, and go, consolidate, and go. Great. If you do this, hourly downtrend achieved, daily high or low here, retarget this high. In a picture perfect world, we consolidate, balance, or whatever, do this, make our way back to the all-time high. If this goes lower high in here, right, this is your breakdown, lower odds as of right now, but we would pay attention to that, right? If this ends up being a lower high where this white circle is that I'm drawing, and we crack the equal low, okay, something's different here, something's changing, right? So we'll pay attention to that. Base case would be these 3 that are pointing higher after higher lows. Heck, you could even just do this, right? That works fine as well. The failure pattern that's shortable is you look over Friday's high, fail back into range. If you could spot the intraday lower high here for risk reward to kick off the trade and then look for that, I mean, that's doable, but don't overstay your welcome, right? These short trades in an uptrend are counter trend. So take profits aggressively, trail and trim on the way down, but you're really not getting any traction on the short side as evidenced by what we just described on the big red bar from Wednesday's failed gap up. So that is what we've got here on the Qs. Let's quickly take a look at the side of the NASDAQ market internals. I mean, just volume inflows all week, really strong on that Thursday session when we get that recovery and break out of the 2-day range. So that, in my opinion, is very compelling. Very flat there on the what do we have? That is Friday. Losing track of my days on that shortened holiday week. Thursday's cumulative build is the strongest of the week. This all makes sense to me considering that we had an intraday trend on Thursday versus flat on the other sessions for the week. What you could say is you could read into the Wednesday session a little bit, second trading day of last week, and just say, hey, Tuesday we had this big liquidation break off the open. Sellers couldn't get the job done. There's no strong selling here. It's technically volume inflows. And then on Wednesday, the cumulative build is bearish, but do we follow through? Once again, look at the overnight here. Sellers, why are you unable to, capitalize on that and send it? Just nobody wants to sell this market. And I think, it's very obvious based on what the leadership in the market's doing. When I say leadership, of course, I'm talking about semiconductors, memory names, software's even bouncing back a little bit, like space theme, optics. Optics are actually starting to crack. That's one of the themes that's going. But anyways, you get my point. Leadership in the market's been really, really robust and strong. Let's go from here over to our market profile and pull this up for the NQ. Just recenter this on the screen, see if there's anything hidden over here that we should be paying attention to. Really poor low on that Wednesday session, get my shortened days. The poor low in here, if we do see some downside, could be a reference point that's repaired. But what would I just say there? I would just say, hey, it's about you repair the low from Wednesday, and you should just be looking for the gap close, right? So that structurally is fine there. Notice that on the Thursday session, the value area is elevated in the session. We do repair the poor high here. Got an excess high and B period from Friday. Very, very balanced session there. Not much to write home about. It's not like we have a top level profile where all the value is up here and all it's going to take is a very shallow move and suddenly we're done. I just think you just watch the balance range break that we saw and just talked about on the daily timescale. With that, we'll finish up the three major indices with the IWM. What's going on with small caps, higher time frame over here. Let's just grab ourselves the right study set. Let's throw on the clean drawing set. And this is the monthly chart to start. What do we see here? Solid green-bodied bar. We know that the 10-year interest rate has really fallen off, fallen off of a cliff the last couple of trading sessions, really last week and just a couple days before that. So seeing the small caps break out there speaks to breadth expansion. Looks great on a monthly bar perspective. Notice that we have a little bit more of a lower wick here on the small caps. That's because of the initial impulse earlier on in the month when rates actually broke out on the 10-year over 4.5%. That was quickly unwound, and I should actually draw a little bit of an upper wick here and some more of a lower wick. This bar looks great, right? It tells us what? Even on the pullback, look at the low of the pullback there. It respects the previous highs. So very constructive for the monthly time scale. This is a highest high. It's, again, has all the same characteristics of the S&P and the NASDAQ at this point, which is pretty compelling. No real need to look at if you really want to. Does the Russell have this much history? Can we go back there to .com era? Yeah, this is like right there. Maybe the RUT would be a little bit better. Oops, RUT. We have RUT. We do have RUT. So small caps through the .com bubble. Obviously, these companies are not the NASDAQ. So yeah, you get a downtrend over here, but is it like, oh my God, the world's ending? Not nearly, right? It's very, I would just say it's volatile and violent. Volatile and violent is the name of the game in smalls over there. Let's go down to a weekly chart. Not much to really write home about on the monthly. A little bit of a different candle here, a little bit more of a topping tail. I wouldn't say that this is like, oh my God, it's the end of the world, but we do have an unfilled weekly gap. That's something to maybe pay attention to. We oftentimes do close weekly gaps. We don't have to close them. I'm not one of those people who subscribe to the idea that all gaps must close because there's plenty of unfilled gaps in the S&P 500. Back to like 1973, there's an unfilled gap that comes to mind. That's the one that I classically reference. But anyways, weekly gap close here, maybe. That's something to at least pay attention to, but what's it going to do? If you pull back and close that gap and find buyers, you're just offering a higher low in the trend count, right? Lows, higher lows. This is pulling back from the highest high, so don't really see any problems with that. So it looks really constructive here, right? Higher highs, higher lows happening here. You could just repeat the cycle, higher low and a new higher high in the future. Let's go ahead and break out our Fibonacci pull from the low up to the new high. You could certainly see that there's plenty of room for the Fib 38.2. If you want to get a little bit more structured with it, you could do this, and lo and behold, 38.2 is kind of close to the top end of that little flag range that we've been breaking out of here over the last week based on the gap up. Let's go ahead and drop this thing. Now let's take a look at our anchored VWAPs on small caps. Here we go. Why are they not showing up? What's going on? Oh, it's because we're on the RUT. That's why. Let's go IWM. There's no volume on the RUT. Anyway, there we are. Looks good. All the fibs would be in the same reference points anyways. So the idea here is that this looks great, right? All over the entire stack of the Fibonacci's as well as the anchored VWAPs. Looks awesome there. Let's drop this thing down. If you want the volume profile, just break it out. Be congruent, as we say. Volume node right towards the lows, or at least the lows of these prior bars. The wick just wicked it, literally. So not overly concerned there. If the market pulls back and supports that high volume node, it's actually a higher low on the bar-to-bar count from the 518 week. Let's drop this thing down now to the daily time scale. Let's finish up our small caps here. A little bit more of a balanced week, right? We did not break out on that Thursday session as meaningfully, but once again, this, if that's a balance range, we've broken out of that, and I apologize. Let me show you a couple things here. Let's go to the expected move set for the month of June. We're looking at 305.81 on the expected move for the IWM. And as a matter of fact, I'm even going to go back to this weekly chart because I want to take a look at the weekly measured move of that bull flag. Sorry for jumping around a little bit here, but I do want to just have the number in the back of my brain if it does go. Let's call it 320 on the upside for IWM. Now, if that happens, again, am I saying that we got to go there this week? No, but if the market's going to move towards 320 over the handful of weeks that are upcoming here, what does that suggest about the market, right? It speaks to breadth expansion, and this has really been the main reason to continue keeping track of the IWM here. Breadth expansion is bullish in terms of keeping pullbacks gentle and mild in the S&P 500, right? So that looks great in terms of a bull flag move there, upper bound of the monthly expected move 305, a little bit shy of it. I mean, this is awesome. This is great stuff, healthy for the market to broaden out and not be so concentrated in that hardware sector, AI, semiconductors, and so on and so forth. So let's go back down to this daily. Let's go back over to the IWM. We've got ourselves in terms of this week's expected move. Let's just take a gander over here. The gray shaded area, as always, 296.94, call it 297, higher high and all-time high. And the lower bounds at 283.92, higher low in the daily trend count for sure. At the daily 20 SMA early on in the week, because we're sideways here, I do expect this to continue higher but start to flatten out in terms of slope. So as of right now, this looks bullish, constructive. You could close the gap, wick off of it, remain contained, and go. You could come in, you could suggest a higher low at the lower bound of the weekly expected move, retarget the top end of the range. Base case would be avoiding a failed breakout, and I would look for this. If it does turn into a failed breakout, I would be bearish on the breakdown through this equal low, and that would be a little bit more problematic. Lose the daily 20 SMA, lose the lower bound of the weekly expected move. That number, once again, is right nestled in there around 282.50s. If you want to use the gray dotted line that we've got off of the structure from in here and the low of the Friday from now 2 weeks ago. So that's it on the daily timescale. Keep it simple, balance, and continue. Continue, straightforward, pull back, close the gap. First idea, bounce off of it. If you do come into the range, target the daily 20, bounce off the daily 20, get back here. Ideally, it's this. If you do roll, I would reevaluate the chart. Here, we'll take that in stride when and if it does become an issue, but it is not a base case. Let's get on down to the hourly chart. Anything new to glean from over here? A little bit of that failed move on Friday. Again, this is the main difference between the IWM as well as our other index products. You can see here that we just failed. So this is already the look above and fail, right, on the micro range here. Now the next step is just to figure out, are we going to close the gap, find a daily higher low and go, or do we just balance, stay sideways, and then some sort of a catalyst comes along and breaks us up and out of the range? Now, what might that catalyst be? It's the brand new start of a month, which always means labor data, right? We will be getting labor data. We'll cover it on the economic calendar in just a second, but JOLTS is always usually the first taste on a Tuesday session. Then we get weekly claims, ADP non-farm payroll, the private read on Wednesday. Thursday typically gives us the jobless claims. Then Friday is the full Monty report. So, a strong labor report here that continues to keep rate expectations lower. That might not be the worst thing in the world. When I say strong, I just mean not completely. You don't want it too weak where it's like, oh my God, we need emergency cuts, but you don't want it too strong where it's like, hey, we can afford to stay way higher for longer. So we kind of want to just hit that sweet spot. A normal report here for markets would probably be a fine catalyst for the IWM to stay sideways or even drift slightly in the upward direction. Too strong of a report, and I do think that you might come in, close this gap a little bit, and then try to figure out where we go from there. So let's just quickly hit this with the Fibonacci's as we do, and just get this out of the way here. What do we have? Fib 38.2, smack on the money with the lower bound of the weekly expected move and the 20 SMA, and this inflection point from back here looks good on a fib perspective. And what about our anchored VWAPs intraday? The entire cluster is going to be right there early on in the week, and probably worth, once again, we'll just take the liberty of dropping in 526 over here, and we will just take a look at where that's at. Midpoint of the range. So again, a little different from the other two index products so far. If you fail this VWAP, start spending more time underneath in the range, maybe get some sort of a descending triangle, I would just take that as a slightly more bearish pressure. Not like, oh my God, we're going to crash and burn, but hey, maybe just dial back expectations a little bit for the S&P 500, right? That's it on the smalls. Let's jump on into our Russell side of the market internals. What do we see over here? Status quo from what we've described so far, mostly volume inflows through the week. Friday, a little bit more lackluster. Over the zero mark most of the week. Friday, a little bit more lackluster. Do you have a little bit more of a bearish build on the cumulative ticks here for the tick, the Russell, I should say. But overly concerning? Not really. Not really, not like blowout reads, and just reflected in the price action as well. This looks more like balance to me as opposed to Armageddon. So that's it through that one. Let's quickly finish it up by taking a look at the final missing piece of the puzzle, which of course is market profile for the rut. I would just point out here that you are seeing value more so overlapping in the midpoint of this range. Notice that the Friday value is just completely centered. It's a normal curve, normal distribution, a little bit of a poor low here, B and C periods on the low of day. And we did happen to topple or at least spend more time underneath the main chunk of value from the Thursday session. Not like overly concerned, but just a little bit of slowdown here. This has been supremely sensitive to our interest rates. So if you're going to be a Russell trader, just pay attention to interest rates primarily. Let's go back on over to the platform. Let's get into some of the supporting evidence, starting with my favorite, the sector tour. Who was leading, who was losing, and where was the weight? Leading the pack last week, software, up 8.18%. Huge break on that Friday session, ripping to the top side. And a lot of those names looking pretty constructive here going forward. Followed by tech, that's bullish. I mean, IGV is not directly one of the 11 sectors for the S&P. So tech up there 4.27%, heaviest weight component. That is absolutely risk on. Mag 7 ETF, again, not one of the 11 sectors, but strong in terms of its indication. SMH, same thing, 1.24%. Discretionary, outperforming the S&P, up 95 basis points. Materials, outperforming 93 basis points there. Bottom of the barrel is energy, utilities, staples. That, to me, the posture here is bullish, right? And RO could always stand for risk on or off. So we'll just put the actual N there. It's a risk on posture. I don't really see anything here that's like, oh my God, they're rotating into defensives and we should expect a crash and burn any moment now. Now, could that change? Is it like, okay, we bought the we bought the crap out of software last week. We need to chill out and maybe rotate into the defensives for a week, let it go sideways, and then restart the bid over there in software and tech? Maybe. But as of right now, it's not directly at the high, enough of a divergence or a lack of leadership where I would say this is defensive. So with that, let's get into the structural charts. IGV, just an absolutely nutty day on that Friday session. Once again, the rotation seems to be take it easy on the hardware, AI, semiconductor stuff, and just go out and buy software and just completely unwind the Armageddon move from the software apocalypse, as they called it earlier on in the year. So this chart looks great to me. I think that the reclaim of the 200 SMA is awesome. I think you really don't want to be a new money buyer smack here, but any sort of tight price action, if you bought this earlier on in the week, the best entry was here off the higher low hammer on the daily 20 SMA. Anything along those lines, really awesome stuff. And now the next steps are just to watch this tighten up, maybe offer some new entries in the upward direction. Heck, any pullbacks over this breakout point, they'd be okay. I don't want to see too much of a failure back down under the 200 SMA. I want it to be short-lived if we do pull back below, then start spending more time up and out above. So looks great here. That's bullish for the market. XLK, I mean, there's nothing to really say other than bulls on parade, breaking out to a new high. You didn't really have that exhaustion gap. Instead, it was gap up and rally into the close. So this looks great. Plenty of room for a daily higher low gap fill reversal, something in here, continuation over an overnight high. That's great. Heck, you could even pull back. I know it would feel gnarly, and a lot of people probably would not like this at all, but some kind of a move in here that then does that, no problem. Daily higher low over the left side peak. I mean, we're talking about, and the numbers seem a little scary these days, but, we're talking about a 5.5% pullback. To see that on the weekly, market minder, I think some people would be a little bit concerned, but generally, structure-wise, that's A-okay. Let's move on over to the Mag 7 chart. This one looks really constructive here. I love the bar on Friday. A little rest before potentially trying to break up and out early on in the week. I will say with the market on close orders for the rebalance, doesn't look fantastic. NVIDIA actually playing a bit of a downside weight there, but I think as long as this is sideways, the look would be for higher out of this Mag 7 chart. We'll see if it can't break up and out over that all-time high at 7120. Let's continue along to the SMH. This one's slowing down. We know that. We just talked about this rotation between software and semiconductors. You could see that this did not break out on Friday, and instead it just rejected the all-time high. I think some sideways action, some sort of like, if you're daring enough to try to catch it here off the low, it's tradable, right? It's risk reward to sort of look like this. Here and here, and then you're back off looking for eventually this when and if the rotation sort of says, hey, let's chill out. We bought enough software. We can let that ride for a minute. Let's get back into the semiconductors, right? So that's the SMH chart. I think 578 looks fantastic. If you start to fail underneath that, that might be a little bit concerning because at that point, right, early on in the week, the 20 SMA will be here. We really, through this entire rally, have not gotten below the 20. Not to say that it's going to be the end-all, be-all, but you can see here we bounced perfectly off of it, gap fill reversal. I'm just curious to see if we do the same thing in here one more time, try to send it back to the highs. If we fail it, now you're talking about that same structure we talked about on the Qs weekly, S&P weekly, head and shoulders, lower high here, probably targets this full gap close again on the downside. As long as you're over this prior all-time high, that really deserves a P in front of it. Prior all-time high, there we go. 509s, monthly high tight flag, weekly high tight flag. Concerns for thin structure retracement, absolutely. If we were to do something like that in the future, we'll wave the white flag. But for now, why focus on this forecast when the base case is probably this, right? Here, 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 sure. Here, sure. Do this, fine. Go sideways for a couple of months, do nothing, right? And then in the future, it's that. That's probably more of the base case rather than Armageddon. Let's go on over to the XLY. I loved the midweek gap up here. I guess it was really just Tuesday. Wednesday. These days, tell you, shortened weeks. I love that move higher there. XLY, thanks to Amazon, nice breakout. Thanks to Tesla with the SpaceX merger rumor, is bullish enough to cause this thing to get higher. I like that because what it does is it now gives us a new higher high to pull back from, meaning that higher lows are acceptable rather than being in this balance like, okay, this is a threat, or like, oh my goodness, this is still a potential threat. Now we can breathe a little bit and say, okay, higher low pullbacks that support the 20, still constructive for the daily trend. Ultimately looking for higher over time. XLI looks fine to me. XLB, materials lightweight sector, fine. No red flags in here. The fact that it didn't go lower high there is all we need to know. Jumping on over to the comms sector. This one is a bit of a red flag. I'll give credit where credit is due. You've got yourself a bull hammer-ish bar there on the Friday session. But what are we doing here? Testing all these lows so many times. If buyers are going to step up and do it, let's just do it. Come on, where are we? So under 115 would be a lot of overhead supply here on a failed move. I'm a little bit not shocked, but we see a little bit of weakness in Google. I think Google will play the major role. But with Meta's recent strength, I would have thought for sure, we could at least have tested or started to flirt with a breakthrough that resistance trend line. Just no dice on that particular move yet. So this is probably the biggest sector concern that I have out there. It's 115 XLC. Let's jump on over the energy sector. It's too volatile to want to do anything with. I don't think it's you're just going to get too much headline whiplash on this. So I'm personally a pass on it. As long as energy is not ripping to the top side, we don't have that inflationary pressure, or at least crude is starting to settle a little bit. Let's go to the CL, not a dot. We want a forward slash. Look at crude here, rolling back lower. That's good for inflation expectations, which does what? It speaks to the TNX possibly moving in the downward direction, right, which speaks to broad market breadth expansion. So I really don't see any problems here with the XLE not really doing a whole heck of a lot of anything compelling. I don't want it to break out, right? So I know the chart patterns there. I know that we have this multi-month, multi-year even consolidation off to the left. This is like the first move out, and maybe this is like a huge higher time frame flag. That's fine. But I don't see it yet with the way crude's going. I know there are a lot of reports about actually hitting some supply issues, inventory issues on crude in the very near term future, but the market seems disjointed from that. The reason crude is so hard, I'll just say this, not that I'm a crude expert myself, but remember, even if you are going to run into an inventory issue and price of crude is going to absolutely skyrocket, you'll just have demand destruction. Nobody's going to go out there and pay for it, right? Who's paying for crude at $180, $200 a barrel? It's companies that might have to operate, but at some point your demand destruction is just going to force the price lower because there are literally no buyers, right? So it's a very, very tricky thing to trade. Very tricky. Anyways, utilities, what do we have here? No hold of the daily 200. Not fond of that. I was actually looking for this to be a look below and fail on the daily time scale and keep us neutral through here. It's a lightweight defensive sector, so it's not sinking the ship, but downward pressure, it does add a little bit of downward pressure. XLP, speaking of downward pressure, failing here, no higher low, able to be established from here to here. Not the end of the world, but just not really what I want to see. I'd prefer that this was continuing to just kind of mildly grind in the upward direction. That way, when and if there's a pullback in the XLK, hey, at least we have an uptrend in the XLP. It can dampen the impact. Real estate rotating back lower. I think this had a nice move through here and we're just digesting at this point. So I'm not overly concerned with real estate. Financials, this one, I'd say not as bad as the XLC, but definitely not looking great. JP Morgan had a bit of a rough week there. We'll see ultimately where we land on it. But for now, I am just keeping track of XLC, XLF as the heavyweight component threats to the market, right? We know that they're neck and neck, each about 10.25%, give or take, for the S&P 500. It's the battle of the beasts. If they start to fail, then, hey, naturally as heavyweight components, let's just keep our wits about us. XLV, not a bad look over here. I think the more interesting thing is your ARC Genomics really starting to get going up and through this resistance trend line. XBI, starting to look like it has a potential for a trade in here. So those names are a bit more compelling to me than the XLV, but nonetheless, this is defensive. So those ARCG as well as XBI, a little bit more bullish and risk on. XLV, definitely more in the defensive arena. So in my view, like, could this just go sideways and be a gentle break of the double bottom? Sure, no problem there. Let's go on over to the XLI. Nothing to really write home about over here. I think that this is fine. If you could just stage a higher low after bouncing off the range low, fine. You know, this certainly would be upward pressure. So biggest flags to point out in the sectors are your XLC and your XLF. Everything else looks pretty darn good still as of right now. Let's jump on into some ratios and see if this tells us anything we don't already know about leadership and posture. If you're not familiar with the ratios on Thinkorswim, check out the video tutorial in the top right-hand corner. XLK looks absolutely phenomenal. No problems there. We know there's problems with the XLF. We know there's problems with the XLC. And I actually don't like that the XLY started to roll here for a lower high on or I should say into the end of last week. I really would have preferred that this could have put on a show, retaken the 50 SMA, that's the gold moving average on these lines. Just no dice. So it's still narrow. It's still narrow over in tech. The good part is just that there is a sub-rotation in tech from hardware over to software again. So that's going to keep this alive, hopefully. No real concerns in the XLV, XLP, XLU ratios. They're in downtrends. They're not really screaming risk off. So we jump on over to the AB sets. What do we see over here? Everything pointing in the upward direction. Even Cathie Wood getting a little bit of love here on the ratio into the end of the week. We looked at the ARC-K on Thursday with the group, and we're just astounded to see, like, oh my God, can you believe it? Cathie finally got something right here. Shout out Sky. I know that's your girlfriend. So in here, it looks good. I mean, that's a little bit of a breakout, right? Instead of suggesting a lower high and like this thing's just a complete dud, Cathie getting a little bit of bid is risk on for the market, right? Obviously, you could look at your Tempest, catching a little bit of a bid there into the end of the week. That's just one that comes to mind. But you know, some of those more innovative names may be starting to go again. Anyways, let's go back on over the ratio. Just wanted to point out that it was a nice look there. Everything else looks fine. Status quo there. Let's go to the B set. And what do we have here? Status quo, no threat from gold is a risk-off rotation. Bond relationship is sideways after the monster rally in the ratio. I'd say Bitcoin, heads up on that. A little bit of a bearish Sailor shift tool ratio firing off there. That's the ratio of the rate of change in gold versus Bitcoin. Shout out Michael Silva. And, you know, generally this, I don't think it's like overly bearish, but it doesn't look good. It's the final missing piece of the puzzle, in my opinion, that hasn't really gone yet, right? We're even seeing solar take off here, and crypto just can't get its butt in gear. So a little bit concerning if you're more aligned with, you know, your Coinbases of the world, circles of the world, MSTRs of the world. So it doesn't look awesome, but it's not enough to, you know, kill the party over here. And I think that's, you know, something we've seen over the last month and a half or so, 2 months, 2.5 months, really. HG for copper. What's copper telling us? Dr. Copper says, hey, we're hanging on to those higher lows. We still look good over here. Your names like SCCO actually had really stellar ends of the week on Thursday. This is not one of the additional trade ideas, although it could be. Break of the trend line there. Low, higher low, equal low, higher low, breakout, inside bar on the Friday session. I mean, it's not a trade idea that I'm overly fond of, but if you wanted copper here, I wouldn't call you insane looking at SCCO. So now I guess it's 6 additional trade ideas with Southern Copper making the cut based on the read there. Let's go on over to the dollar and interest rates. What do we see from this perspective? Slightly weaker dollar, slightly lower on interest rates here to end the week. Nothing we didn't know was already in force. I'd say the biggest thing last week was just the move on Monday, Monday, as markets were closed in equities, we saw like the resolution, or at least the MOU, right, to start wrapping things up. That additional 60-day ceasefire pause definitely put the pressure on crude oil, and the relationship, as we know, has been lower crude equals lower interest rates. I'm just going to say 10-year, right, which of course means higher equity prices, specifically in small caps, right? That's the path, if you will. So the fact that rates are down, good, makes sense. We saw crude falling off of a cliff. Let's go on over to, let's go inverted ZT. What's the Fed watch looking like? Probably just unchanged at higher for longer. They're still probably pricing in that 127 rate hike, but rather than guess, let's just go take a look. And survey says, off by a little bit. Instead of the first of the 27th year of the 2000th year, if you will. It's the 3rd month. So looking at March for a rate hike. Again, I'll just continue to say it in case we have new people watching the video, but you're not going to hike rates and have any impact on inflation if it's coming from the Strait of Hormuz. It's just not how that's going to work. If we go look at the Forex calendar, Forex factory calendar, I do just want to go back over here. GDP numbers right? I mean, a 1.6 missing the 2.0, it's not like they're running the economy red hot and, oh my God, we got to slow this thing down. Inflation's showing up because of crude, right? We kind of know that. So I think it would be insane to think that the Fed's actually going to hike rates over here. I think if anything, you might just be higher for longer, but you're probably not hiking. You're probably still looking at cuts eventually when, things maybe settle down in the Middle East more so than they already have. Crude oil starts to come down, production re-ramps and gets back online. That would be sort of the tell to me to probably look for, if we can get another additional leg at the end of this rally from repricing multiples based on lower rates, that would be the thesis there. Let's go back on over to the calendar though and look forward for the upcoming week. What do we see? We mentioned how it's the labor week. It absolutely is. You can see manufacturing PMIs to kick us off on Monday. That's the ISM, usually a little bit more important than the final revision to the S&P Global. Then here it is. There's the JOLTS number on Tuesday morning at 10 a.m. You can see here is the Wednesday ADP non-farm. Here's your ISM services PMI. That's always important. Besant speaks at the same time. Let's see what Besant has to say about frozen Iranian funds or how they're going to structure that deal over there. Right now, they're talking about many billions of dollars to rebuild, I suppose, is kind of what's on the table right now. Just like neutral opinion outside of that, let's see what Besant has, or at least how the market responds to the idea of that. Beige book for the Fed nerds is always interesting. We could watch out for that one. Jobless claims, usual stuff. And then there it is. There's the full Monty labor report on Friday. We'll go ahead and have coffee and donuts on me up here in the Penthouse office south. We're back home in the main office here, which is always a pleasure to be in. So 8:30 Friday morning, we'll kick it off as we always do. Every day we're live at 8 o'clock Eastern time. Earnings calendar for the coming week's worth of trade. Credo, absolutely interested in watching that. Monday after the close. HPE, bare metal, will be interesting after the close as well. Even Hive has gotten a little bit of love recently. Dollar General, not as interested. VSCO had an interesting chart a couple months ago. Not really interested anymore. Tiger Broker, they kind of got squashed on that China regulation headline. Palo Alto. So let me just clean this up a little bit. Credo, Palo Alto, absolutely. That's it for Tuesday after the close. Nothing Wednesday before the open. Broadcom, CrowdStrike, absolutely. C3AI is just a big disappointment. They got the best AI ticker. It's literally AI, and the stock just sucks. So I would stay away from that. If you want some popcorn, maybe you could watch it then, but that's pretty much it on Wednesday. Sienna, absolutely, before the open on Thursday. It's been a little bit disappointing over in the optics names. Unable to find higher lows over there. Rubrik for sure. Planet, of course, not as interested in Lulu. And that's mostly it. TTAN, software named, maybe pay attention to. You could argue for Samsara as well, IoT. But that's it. That's pretty much the earnings calendar. Biggest mover for the S&P 500 will be Broadcom. CrowdStrike has been on a tear recently. I would love to see that thing settle down and offer some kind of a tight setup. It's been on a tear. It's not really allowing any entries, but cyber as a whole is a really interesting look recently. So that's it through the earnings calendar. Last week, just to cover it, they did not release a FactSet report. So always grateful to when they do release information. The shortened holiday week, they tend to not release it. So doing a little bit of digging on our own. This is the summary from Marvell, just pointing out 28% revenue growth year over year. Data center revenue, making up a majority of that gain. Of course, up 27% year over year. Big margins, 58.9%, awesome, and 80 cents of non-GAAP EPS. Just record company and data center revenue. There you go. That's the bottom line here, and that's what we continue to see. Marvell was a little bit I hesitate to use the word overbought, but the failed gap ups on Tuesday and Wednesday sort of set you up for a very disappointing, like nothing burger on earnings. So I don't think there's much to write home about there, but the numbers are healthy enough. The main point I'm trying to illustrate is that revenues are up to back the move higher we've seen in the stock. If we go on over to this one, this is perhaps the most interesting one, Dell. Dell. Thank you, Dell. What just incredible numbers. You got 88%. Sorry, I won't shy of the extra 8%. 88% year over year revenue growth at Dell Technologies. Part of their infrastructure, you could see here, up 181% on the year over year. Which is absolutely insane numbers here from Dell. I mean, you could read through this deck if you'd really like, but, are they deserving of the nearly 110, 120-ish point gap up that they got overnight? Absolutely. I mean, these are just knockout numbers from a company that used to be a little bit more so thought of as a dinosaur. Thought there were some interesting breakdowns through here. If you're interested in reading this, you could find it on their IR website. But, if you want a little bit more detail about what's going on here, this is pretty fascinating. Their rack systems, and then traditional server growth, right? And I mean, you can just go through this at your own pace. There's just a lot of stuff here that's really positive through the Dell earnings report. And once again, do they deserve the massive gap up that they got? I mean, I would think so based on the numbers that we've seen here. So that's kind of a look back at the two major players from last week. We sort of looked forward at the upcoming calendar. I think we go back on over to the platform here and finish up through our supporting evidence. Bond relationships moving lower indicates to me that the market is getting a little bit more excited about repricing inflation expectations to the downside as crude oil continues to move lower. As we jump from bonds over to credit spreads, continuing to move lower is bullish for risk appetite. Nothing to read into there. HYG has broken to the upside. We know that this has been more so correlated with crude oil and thus the 10-year rate. And then, of course, your junk bonds start to go with it. So with that, I mean, how can I look at this chart and say, okay, look, junk is finally starting to go as we're breaking out through this equal high. We've been divergent here, and yet the market continued to go higher. The bears, what is going on? This pullback, double top, right? We talked about it as kind of a joke in last weekend's video. Hopefully, nobody got too aggravated with the clickbait title. There we go. It's pretty quick to say, like, that's not a base case. That's what the bears should have done in the face of a bearish divergence like this. And instead, what happens? No, it breaks out, right? So just nothing to really lean on if you're a bear here. And typically when we start saying things like that, it's like, okay, don't bite your tongue too hard because, it could turn around in very short order. But for now, I think we stick with it until something clearly changes. The moving average charts, small pullback there into the end of the week on the month on close rebalance, new highs versus lows, still staying positive. What this indicates to me, believe it or not, this is not overbought. Right? Look at what happened coming out of the tariff tantrum, which would have been, here, April of, hang on a second. No, this is this year. What do I want? I want before that. I want last year's tariff tantrum. Sorry, let me grab 2 years here. There we go. Look at the tariff tantrum here. Right? Oh my God. And then look at the rebound. Look at how frothy things got up towards that 80% read. Right? And look at where we are now. So, there's two perspectives here. The first perspective, which I personally would take right now, is that things aren't overbought. The market's not overbought at all. It's, it's not like we're just screaming to new highs. Look at this. This is like overbought, right? And then we know that the market slowed down here, headed into that, October when the China tariffs were sort of like put back on the table. NVIDIA earnings, really good news there. That was November. It was like, okay, that kind of marked a little bit of a topping action as well. So just not as overbought through that situation, which in my view, this means that there's probably more room to float higher here on breadth expansion as and if interest rates continue to move in the downward direction. So I see this as being bullish. I could understand if you're like, oh, this just means the rally's weaker. I mean, sure. But my perspective here is the more optimistic one, and generally it pays to be an optimist in markets. Here's your RSP. Nice breakout last week and, follow through to the top side, bullish for breadth. I don't think this is much of a shocker considering much of the conversation that we've had so far in today's episode. If we look at the VIX, just completely melting. One thing I will share with you guys, let's just go on here and type in Bollinger Bandwidth and just set that up. Fine, that should show up down below. We don't want any of that additional junk. I don't want to see the bulge and the squeeze. No, thank you. No bulge, no squeeze. I'll pass. As we come into our Bollinger Band width on the VIX, I'm just going to go out to we could just go to a weekly. No, it's not going to illustrate it as well. Pretty much want the daily. What I'm trying to illustrate is the complacency effect, right? And you could probably run a study on this and you could go out and you could find the number, but we're pretty much at the lows, right? 16 in terms of points. Let's just do this real quick. Do that. There we go. See how this floor in here is at like roughly 13 to 16 on the Bollinger Band width? It doesn't guarantee an explosion of volatility. It doesn't guarantee that, oh my God, we're just going to like be off to the races. But we do have to have in the back pocket that the complacency effect is in force, which just means that nobody's hedged. Right. And when nobody's hedged, it makes it that much easier to say like, okay, cascading effect when and if you actually start to see a little bit of selling. That's my main illustration here. It's not a bearish data point where I'd say, oh my God, just go short the market because of this. It's just like a little bit of a back pocket understanding to say, okay, I'm not going to be shocked if things start to turn over and we do see a volatility spike because nobody's hedged right now. Like, and why else can we say that? Let's just go on over to the VVIX. VVIX also melting at some of the lowest levels we've seen in a very long time. And most importantly, let's jump on over to my favorite, which is just the volatility futures. I mean, look at the curve here. This is not normal to have a volatility futures curve of 2.31%. That means nobody's hedged right now, and there is an increase in volatility. I mean, you could see this over on the trade tab here. Let's go to the VX. Open this up. Look at this distance, right? This means that right now for the month of June, everybody's like, yeah, not much volatility. But in the very near-term future, we're expecting an increase in volatility, right? So, I mean, the curve in terms of the duration, it looks right. But the distance here just means that there's quite a bit of shock factor in terms of the steepness of that line, which is just, as illustrated by the height of this line, if you will, the value of this line, how extended that is from our normal past from over here. It's pretty normal to have on the front month in here, something closer to 0.9, something like that is a little bit more normal. So it's just a little lofty there. You can see it more normalized in the back of the curve, which is these dimmer gray lines in there. Anyways, that's your volatility read. You could go out to the skew. You can see that the skew probably tells us nobody's hedged either. Here's the skew. Yeah, nobody's overly hedged on the skew, which is fine. Then we could even fire up a P call while we're at it. And you can see this is low, right? Nobody's buying puts in here, which, I mean, for good reason. We're just screaming at new highs, right? Anyway, that's your supporting evidence. Let's rip through the core list of companies. Let's get the job done here. And then I've got 5 trade ideas for you in addition to the SCCO, which we've already talked about. NVIDIA, what an interesting close there on Friday. I'm a little interested to see if that was just a month-end rebalance, if you will. Some people are overweight NVIDIA, want to rotate into some different stuff. They're going to close out. We haven't taken out the Wednesday low, getting my days correct. We haven't taken out the Wednesday low, so I think we're okay here, but I hate the look of the bar closing week, literally smack on the lows. Here it is. It's like market on close orders in the last 5-10 minutes of the day. It's really put the pressure on. So I would think you just have to resolve this range now. As annoying as that is, as much as it might be like, oh, I want to trade NVIDIA somewhere in here, your best trades are either going to come from a Brigade bolt above or a Brigade bolt below. That is it. Anything in here, I don't want to say it's complete noise. Maybe we get some new structure that actually builds out, but your best trades on NVIDIA, well, you'll have to be a little bit more patient. Over 218.35, under 209.75. That's what I'm watching for. I would prefer that it's higher out of that. I would prefer that we could treat NVIDIA like this, right? Can we get some kind of a symmetrical move out of the flag? TBD. Friday's close does not give me the warm and fuzzies. Let's go on over to Apple. A little bit of a failed breakout at the highs and just kind of a stubborn chart in here, just grinding. So I don't have a big thesis or idea on Apple. I would just say it's very obvious where the deeper pullback comes in, which of course would be underneath this 308.50. If that happens, great. Get the pullback. Higher low in here, I would start looking for longs at 303.25. If we're just grinding around, probably not as interested in trying Apple up there. It's going over to Microsoft, really nice bid into the close. Software stuff getting in gear. They signed that government contract here. It looks great. Looks really, really strong. I like the pullback that held over 442.50 intraday. Probably looking at the 200. Would like to see it tighten up. Any pullbacks over 430 work as well. A little bit of an unfilled gap that I don't have marked out in there, but over 230.50 makes decent sense. Daily pullback 2-3 days down, then back off to the races to see if software continues to get a bid. I would say a huge red flag for the market overall, not just Microsoft, but for the market overall. If software can't step up and keep this bid going, if Microsoft turns into a failed breakout and we're here, oh my goodness, that I would have to imagine that this gets paired with a pretty concerning look over in the S&P 500 or at bare minimum the QQQ. So watching that very closely. If there is a failed breakout, it's not the base case. I like the break on volume with the catalyst. It makes sense that it should be higher here, but it's just a matter of finding the next tight entry point. Let's continue along. Let's take a look at Amazon. Not as good of a look into the end of last week, failing the break over previous day's high, closing week at the lows, still surfing the 20 sort of in here. Best look would be to just quickly wick it, come back above, put in the consolidation over 269.50, and then carry on towards the all-time high. So looking at the intraday chart, right, the best outlook here would be that this is I know it looks like a head and shoulders. I totally see that. But if this is like generally the break, Brigade bolt higher low firming up over the 20, it's just where you need to find buyers, right? And then this thing maybe is just a flag that looks like this, and then we're over 273.50 for higher. That would be the look. That's constructive. Let's continue along for Google. Google, I think, is a short watch this week. Let's take a look over here. Huge winner through the lows off of the ceasefire announcement originally back in April 8th, and we'll see if we can't just get a little bit of head and shoulders to correct this thin structure retracement. Something that looks like this, doable, 381 down into the top of the gap at 365.75. When we get here, absolutely more interested in higher lows to see if this wants to continue. Cloud growth 60% year over year. I just don't see a world in which Google gets punished for very long. I think that this is a buy the dip opportunity for the long-term account. I think Google's one of the better companies out there in the world right now. Huge benefit for AI. Just It's too much data to work with. Leader in search, bake Gemini into Google search, and you're just, you're native for a lot of people already. So I think this story-wise is fine for AI, and I think in the short term we could just experience a little bit of turbulence on a pullback underneath this 381 thin structure off to the left. We'll see what happens here at the 365.75 mark. So that is that one. Definitely bearish in the short term, but then trying to change tone, partial gap close. And another thing, just FYI, if this does look below and then fail immediately, if we get like Tuesday or Wednesday back over 381, I mean, how does it not look below and fail? Massive daily higher low versus the gap and target top end, if not all-time highs. Let's continue along to Broadcom earnings this week. It's been a train wreck of an intraday chart. We sort of posted about this online. I mean, what are we doing here? It looks like horrible, but if you just kind of sitting back from my desk, I'm way over here now, and I kind of squint my eyes a little bit. It's just a bull flag. Like on the weekly chart, it's just a bull flag, and it's starting to break out on Friday, and it's annoying, and it's sloppy, and it's choppy in here, and like, God bless you if you're trading it, but I don't really see much to do with Broadcom until we're through earnings and hopefully setting up something tight over 437.60. Like if we could get anything higher, pulling back, tightening up in here, and then looking for a higher low, sure. But until then, it's kind of a pass for me. We'll see what earnings have for us. Let's go over to Meta. I love the hammer on Friday. A lot of people in the group got long this on Friday, and I think for good reason, like getting long in here, really not at the highs. Looks good, looks really good. So 621.25, retest the balance range high breakout. So Brigade bolt there, equal high test, if not higher, for next week. Really looking for, 666, the devil's number up there, the 200 SMA. Sure. Looks fine to me. Daily higher lows, trying to creep out of this. Another ad revenue stream, or not ad revenue, but rather just another revenue stream for Meta. That was the main idea on that Wednesday breakout there. So, that changes the value of the company, or the perceived value of the company. It depends on how successful this whole Meta One subscription thing is. Anyways, moving along. So you get catalyst on Meta. That's the main point. Forget about it. I'm not a fundamentalist, but the catalyst is what matters. Eyeballs on the stock, volume increase, right? That's what matters. Anyways, Tesla. Is this a higher low? It looks like it to me. This entire little N, if you will, has been really not frustrating. There's been some okay trades on Tesla, but it didn't really offer like the cleanest daily setup, just like straight down, straight up, no real entries. And I think now it's trying to say, do we want this, right? And that would be the watch there. So watching Tesla to treat this as a daily higher low on Friday. As we take a look here, Brigade bolt out of the 2-day balance range would get interesting over 444. The reason for that, right, is if you're a seller, you want to see this. And as a matter of fact, we took a really beautiful short scalp on Tesla midday on Friday. It was the best trade of the day there outside of Apple. So, and outside of trimming Dell up 100 points post earnings, but we'll let that rest. Anyways, really nice lower high short, thinking that, okay, the sellers are breaking down from a 2-day balance range and failing this breakout point, only to get rebid back into the close. So, good for a nice trade there. It was short lived, but then anybody who overstayed their welcome got steamrolled on Tesla back on the upside. So my take here, and it's always fun when this actually happens with a trade you're in, is that you learn something about the nature of the sellers here. The sellers weren't really all that strong, and the close looks okay back over this 435. So if we can balance here and do this, I would want to be interested in over 444, target the equal high, if not the gap close above, over the span of time, closer to about 470 to 473.70. Let's move along, talk about JP Morgan. It's a very boring one, but it is important for the financial sector. You got highs, you got lower highs. I'm concerned about lower highs under the moving average stack at this point. The 200, the 20, the 50, they're all in there. Even if you go dead cat bounce, lower high is just going to put the pressure on. XLF, third heaviest weight sector by market cap. It's kind of a tough look. Don't love it. MU, nice break of the inside bar, but I mean, hardly should I say nice. It was like just chop and then buy it into the close because everybody needs to own memory. It's the best performing stock out there. Just buy MU, right? And it's still cheap by PE perspectives, which is crazy. So, is MU just going to continue to float up and away? Maybe it doesn't really seem like it's acting like your NVIDIA of the world, right? NVIDIA for hardware and semi is just not really doing it. Getting sold aggressively. Intel, as we'll see on the bottom of the list here, getting sold down 7.4% on Friday, right? Pretty tough, but your MU looks pretty good. SanDisk is not one of the additional ideas, but I will show it here just because it's relevant, obviously, as a counterpart. I think this looks great. I mean, SanDisk looks awesome for potentially this. You're probably looking at MU at 1K, and you're probably talking SanDisk at 2K, right? S&DK, 2K. Give them the Livermore numbers. Let the traders rejoice at the round figure, and then we'll figure it out from there, right? It's really not that far away. 2K is here. That's like last week and a half here. Just double it, right? Fine. And then on MU, just going back over, 1,000 is just spitting distance. Probably hit it on Monday if we get any decent overnight news there. Okay, so that's it. On that, let's go on over to AMD. Let's take a peek over here. Daily chart to start. I like the inside 3-bar play. Ignore this. I know some people were asking me about this. Ignore that. No real concern there. You just want to focus on the NVIDIA conference that's upcoming. Anyhow, inside bar, it looks, as much as it's extended from the 50, as much as it's here, I think it looks okay for a day trade, but you got to be able to get in and out of it quickly and not get stuck at the highs. So I think it's day tradable out of the inside bar, but I don't think you want to be looking for new swings here extended from the 50 and just kind of like up and away. It's been incremental higher lows. It continues to work well. It's in an uptrend. We know that for sure. It's strong. It's, totally overtaking NVIDIA right now, but I think you'd probably need to be a little careful with the, buying this at the highs. You need to be as close as possible with a setup, not just randomly, but you need to be as close as possible to about 523.85, all-time high level, some kind of a Brigade bolt there. If it fails, right, it comes back in, I don't think anybody should be shocked. So if you try it, be willing to stop out. If it fails back in, then you're probably talking about a deeper pullback, right? Take out the neckline, hourly downtrend, daily high or low here. So something along those lines, right? It's going over to Intel, just a nasty day on Friday. I thought Intel was setting up well for the potential of upside, and it just could not get the job done. Thankfully, there's really no 2-minute buyable opportunity on Friday morning, but over these multi-day highs, you'll see the upper wick means it failed. So it tried above, it failed, could not get to the all-time high and closed really, really heavy there down towards the 20 SMA. Next watch would just be a red to green move early this week. Maybe we treat this as a daily high or low. That's the watch, that's the opportunity. But if it just continues to drift and get pummeled, then, so be it. You'd probably look for shorts, honestly, on Intel, seeing if we can't get a little bit of an equal low test back here. So big watch for me is actually Friday's close. It's not so much a particular level. I mean, if you want to use this 114, you can, but it's Friday's close. Red to green, buyable back to the range high, I think, and red to red and just staying red underneath like an intraday VWAP or whatever, that's bearish, looking for follow through down towards 100. Okay, that's the core list of companies. Next up, we've got these additional trade ideas. Let's go right through them in alphabetical order. Circle is up first on the chopping block. I struggle to see Circle as being like definitively buyable in here. I do need to give it credit though on the higher time frames. I'm trying to remind myself of this. Is this cup and handle-esque? Is this a breakout over 136? Maybe. I still struggle to see it with Bitcoin and Ethereum doing what they're doing, but it's worth keeping an eye on, I believe, in this general zone. I personally want to see it shape up, offer continued higher lows, and then maybe have some kind of a tight enough setup here to try it for a breakout, pre-breakout, get it on, higher low pullback or whatever, and then look for the 136 continuation. That's it, right? Maybe we get that. A lot of eyeballs online, a lot of people talking about Circle. I don't see the setup yet. If you're long from like Thursday's low, how can you complain about that? Obviously it's working and that's fine, but I don't see the setup yet personally. I just want to keep an open mind to it in here if we could tighten up in that neighborhood. Next up, DOCN, DOCN, DOCU, not sign, but DigitalOcean. DigitalOcean, I mean, just anybody who's built a little home-built app, a little vibe-coded app, you know what DigitalOcean is, right? You got your droplets going. So is the $8 a month going to be enough to do this? I don't know if it's our $8 a month paying for a little droplet, but the chart looks great. Chart looks awesome here, consolidating, building these higher lows, holding the 20, tight days on Thursday, Friday. Can it get going? Can we get involved, front run the breakout there with smaller risk, something that looks like this versus having to buy the breakout, put the stop here, then your risk reward's not as good. So looks really clean. 164.35 top watch on DOCN, and would love to see it sort of, offer a couple of things. Either look below and fail the 20, and then we're higher, stop here, entry, reclaim VWAP intraday or whatever. Then this, if you want to wait for it here, that's fine as well. But it's just a beautiful chart. Peg setup in here, worth continuing to pay attention to. CIFR. Alphabetical, C, D. How did that get messed up? CIFR is up next. I do like this as a little multi-day consolidation after breaking through this range high, and the higher time frame chart here looks pretty good to me. Remember CIFR, this is my take at least, I think CIFR here could be the early stages of a mirror of NBIS, right? I know you might be thinking like, that's not even close to the same, but chart-wise, same thing, right? Chart-wise, similar. There's your big rounded base, starts to get excited, pulls back really sloppy through the moving averages there. But once it gets going, right, you're off to the races on that NBIS. So taking a look at CIFR, like sear this chart into your brain for a second, NBIS, go back to CIFR, and you're like, okay, I can kind of see it. You can kind of see that rounded base. Like, is CIFR going to go sideways, maybe another washout or something, and then go? Maybe. right? Maybe. So I would think CIFR is a decent watch in here. You could watch the group as well. Your HUTs of the world, HUTs probably stronger. Your APLDs of the world, APLD, there we go. Your cores of the world, but I think CIFR would be the one that I'm personally focused on. If you already own HUT, great, keep focusing on HUT. I think you'd probably watch that as a 3-bar play as well, but CIFR looks like it hasn't broken out of the base yet, which is a strong opportunity. IREN, next trade idea. Speaking of data center, look at this little hammer action happening in here. I'm already in NBIS, so I'm more than content with just holding NBIS, but looking at the group kind of in this neighborhood right now, IREN looks like it could be next, right? Nice little hammer action. Look below and fail previous day's low. Nice expansion of range here. High volume on the up days, low volume on the down days. Do we have some sort of a buyable high through Friday's high? Do we have sort of another look below and fail at this 58.40s? Is there something to do here on a 2-day pullback as a flag on IREN? I would think so. It's in a leading group right now. I would treat it with some respect. And last but not least, you've got TE. T1 Energy. Leopold has blessed this one as well. Look at the volume coming into it as soon as he said, we're going to own that. Hammer candle, very straightforward, right? Hammer candle here on a single day pullback. Look below and fail previous day's low. Didn't quite come into the 950 alert. This chart actually reminds me a lot of Ondis. But Ondis did the deal. Ondis came into that 1160. And this also could be a trade idea. I didn't include it in the list, so you've got a couple extra ones in today's episode. But 1160 Ondis inside hammer out to 15 out of this range break, sure. We know the catalyst there is U.S. government interested in domestic drone production and so on and so forth. TE, though, as a trade idea, is this, a good enough pullback over a left side peak after cup with handle? Sure. Right, 950 could be interesting there on TE if we could support it and go up and out for this particular name. And that's it. That's going to do it for today's episode and installation of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. That's all it takes. Lets me know that these things are worth still producing. As always, we'll be live every morning at 8 a.m. Eastern time for another episode and installation of the pre-market prep. We build a game plan for the day ahead, and we cover any relevant news that may have happened overnight in between our, of course, Saturday weekly watch list video versus the Wednesday midweek market update. So coming out to the channel, 8 o'clock Eastern time every morning here live pre-market prep. I will see you there. Have yourself a fantastic, relaxing weekend. Stay green this upcoming week. And as always, I will see you in the next one.